Another day, another story. Jobs and career in biomedical. This article was written by Joran Radanovic and was published in trustworthy.com. As a high-income earner, keeping more money in your pocket requires you to decrease your taxes. You can use several strategies to lower your tax bill. Who is considered a high-income individual? According to the IRS, high-income earners are individuals belonging to the top 3 of the 7 tax brackets. If you make more than $182,100 annually in the 2023 tax season, filed in 2024, as a single person, single head of a household or married but filing separately, you're a high-income individual. A person who is married and files jointly making more than $364,200 annually is also considered a high-income individual. You can use several or all 12 strategies to reduce your tax bill. 1. Make the maximum retirement contributions. Lowering your taxable income enables you to shift into a lower tax bracket. One way for high-income earners to do that is by maxing out their 401k/403b contributions. A 401k is offered by private, for-profit companies, and a 403b is offered by tax-exempt and non-profit organizations such as churches. These retirement accounts tax the withdrawals you make in retirement and not the contributions or earnings. This defers your tax and reduces your adjusted gross income during your high-income years. The reduction in the adjusted gross income enables you to be taxed at a lower rate today. Choosing not to max out your contributions means that the unclaimed portion will be treated as income and taxable in the year earned, placing you in a higher tax bracket. The maximum contribution for a 401k and 403b in 2023 is $22,500 for under 50-year-olds and $30,000 if you're 50 or older. The other advantage of having these retirement accounts is that employers match a certain percentage or the entire contribution of employees. If you contribute the maximum amount, $22,500, and your employer matches contributions 100%, your annual savings will be $45,000. Your employer's contribution does not count toward your contribution limit. However, the total limit between employee and employer cannot exceed $66,000 annually. Not only does contributing to a 401k/403b lower your gross income so that you're taxed at a lower rate, but your retirement savings increase with your employer's contribution. 2. Contribute to a health savings account. A health savings account, HSA, is a personal account enabling you to save for qualified medical expenses. The 2023 contribution limit for self-only coverage is $3,850 and $7,750 for family coverage. If you are 55 years or older, you can contribute an additional $1,000. Contributions made to an HSA reduce your gross income when made by payroll deduction, so you're taxed at a lower rate. HSA contributions aren't taxed, nor are the earnings and distributions when used for paying qualified medical expenses. You can withdraw these funds at any time to pay qualified medical expenses such as x-rays, bandages, prescriptions, dental, eyeglasses, first aid supplies, and more. This strategy is useful if you want to avoid hefty medical expenses when you're older. 3. Convert to a Roth IRA. Do you want to enjoy more of your money in retirement? Then you need to invest in a Roth IRA because distributions in retirement are tax-free. A traditional individual retirement account, IRA, enables you to make contributions with pre-tax dollars and then be taxed on your withdrawals, which include all the earnings you accumulated. So, how do you delay taxes and not have any in your retirement withdrawals? Convert your traditional IRA into a Roth IRA. Contribute to a traditional IRA and then roll it over to a Roth IRA, which requires contributions with after-tax dollars. When you complete the conversion from a traditional IRA to a Roth IRA, you will be taxed. But since you decide when to do the rollover, this is a great strategy to determine when to be taxed on the contributions. Earnings and withdrawals in a Roth IRA are not taxed. The amount you choose to convert is added to your gross income and taxed as ordinary income. Regardless of income or filing status, anybody can convert to a Roth IRA. There is no limit on the amount of rollovers into a Roth IRA. To keep making contributions after the rollover, contribute to the traditional IRA and then do a rollover into the Roth IRA. The maximum contribution to a Roth IRA for 2023 is $6,500 for individuals under the age of 50 and $7,500 for those 50 years or older. Whereas a traditional IRA has a required minimum distribution, RMD, at age 72, a Roth IRA does not require withdrawals until the death of the owner. 4. Buy municipal bonds. Bonds aren't the most attractive investment option from an earnings perspective, but tax-exempt ones provide certain benefits. The interest from municipal bonds is exempt from federal tax. This asset class is usually a low-risk investment because buying one entails loaning money to a government, which pays set interest payments until the bond matures. When the bond matures, the issuer reimburses you the original investment. The income from bonds is free from federal taxes. Municipal bonds issued by your state may be exempt from state and local taxes. The best way to buy municipal bonds is through a broker, which usually provides a self-directed account, enabling you to monitor prices, ratings, and execute trades. Using your after-tax dollars to invest should be tax-free. And that's exactly what municipal bonds provide because you don't pay any tax on the interest earned. You can hold a municipal bond for 1 to 3 years and even up to 30 years. With an investment of $100,000 and an average yield of 3%, you would make $3,000 annually, which is tax-exempt. Since interest is paid out every 6 months, your initial investment would be $134,685,50 after 10 years. 5. Establish a donor-advised fund. If you want to contribute to charities and enjoy tax advantages, establish a donor-advised fund. It provides control of your donations by enabling you to decide how and when to distribute grants to individual charities. You claim the deduction when made but decide later about its distribution. You claim a tax deduction of up to 60% of your adjusted gross income for cash contributions to a donor-advised fund. This strategy is useful to high-income individuals who experienced a significant spike in their income in a particular year. 6. Tax residency planning. Choosing where you live impacts your state taxes. Consider establishing your primary residence in a state with no income tax. This strategy is especially useful if you own property in multiple states because you're renting them. States that don't enforce an income tax are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, Wyoming. Moving to a new state, especially if you need to move back because it didn't work out, can be burdensome if you have a spouse and children. This strategy is most suitable for single people who work remotely. Carefully consider estate planning with a tax professional to determine which state to establish your primary residency in because it may have high tax rates for other items. Before moving states, look into factors such as levies, property taxes, which tend to be higher in states with no income tax and sales tax. 7. Invest in qualified dividends. Ordinary dividends are taxed as ordinary income, which max out at 37%. Instead of opting for ordinary dividends, invest in companies that pay qualified dividends, subjected to capital gains tax rate. These are issued by a United States company or a qualifying foreign company. The tax advantage of qualified dividends is that their tax rate tops out at 20%. However, certain tax situations dictate that you may be subject to a 3.8% net investment income tax. Speak to a qualified tax advisor for specific details on your investments. Investing in dividend stocks is done with after-tax dollars, and you want to keep as much of your dividends as possible by avoiding the highest tax bracket. 8. Hire your children to work for your business. Add your children to your payroll by hiring them to work in your business. The tax advantage of having your children on your business's payroll is that you can deduct their salary as a business expense, which reduces your taxable income. This applies even if you are registered as a sole proprietor. If your child is under the age of 18, you won't be required to pay Social Security or Medicare tax on their salary. This strategy is perfect if you want to shift a portion of the business's income from your tax bracket to a child's tax bracket. Your child will not pay any tax on income if the annual earnings don't $13,850. Let's assume your business's income is $185,000, and your child's salary is $13,000. Instead of being taxed on the full $185,000, your business's taxable income will be $172,000. 9. Invest in 529 College Fund for Kids. Certain states enable taxpayers to reduce their taxable income by contributing to a college fund for their children. The contributions aren't tax deductible for your federal taxes but are deductible in certain states up to $10,000 and they grow on a tax-deferred basis. Contributions to a 529 account offer gift and estate tax benefits for federal tax purposes. Your contribution qualifies for a $17,000 annual gift tax exclusion in 2023. But you can treat the contribution as processed over 5 years for gift tax purposes, enabling you to make an annual contribution of up to $85,000 to be treated as an exclusion. Your spouse can make the equivalent contribution to your child/grandchild without triggering the gift tax. This strategy is suitable for parents and grandparents who want to ensure their child/grandchild's future by sending them to college while reducing their own estate taxes because contributions to a 529 plan are exempt from federal estate tax. Federal estate tax is currently applicable to estates valued at $12.92 million but may drop to $6 million by 2025. Certain states impose state estate tax on estates worth $1 million. 10. Make Opportunity Zone investments. You can use the Qualified Opportunity Zone (QOZ) program to defer paying taxes by investing in economically distressed communities. Taxes on eligible capital gains are deferred, discounted or exempted on a federal level by investing the gain, not the proceeds of a sale, in a cause within 180 days. Holding a cause investment for 5 years enables you to receive a 10% tax exclusion of deferred gain and an extra 5% if you hold it for 7 years. This strategy is ideal for multimillionaires as you need to be an accredited investor to invest in many cause funds. 11. Take a real estate exemption or use a rollover. Owning real estate enables you to take advantage of capital gains tax. You can reduce or defer taxes, but it depends on how you use the property. Selling your primary residence after 2 years, doesn't have to be consecutive, of living in it out of the 5 years before the sale enables you to exclude up to $250,000 in gains. A married filing jointly couple can exclude $500,000. The ownership and the use of the primary residence don't have to be at the same time. What's important is that you own the property and used it for at least 2 years. Another option is doing a 1031 exchange with an investment property tax. 12. Start a family. The federal government is rewarding taxpayers for having children with the child tax credit. High-income earners receive at least $2,000 per child annually. Individuals who can take advantage of this tax relief are married couples making less than $400,000 and families with a single parent making less than $200,000. Thanks for watching. Jobs and career in biomeditech.